All right, let's get right into it. We are looking at Rivian Automotive, ticker RIVN. And this is a stock that is absolutely on fire this morning. As of 9:51 a.m. Eastern Time, November 5th, 2025, Rivian is trading at $13.67 per share. That is a massive move, up $1.17 on the day, a pop of 9.36%. Volume is already heavy at nearly 6 million shares traded in the first 20 minutes. This is a huge, aggressive, front-footed move. Now, the immediate expectation for anyone just glancing at the market is that Rivian must have crushed its earnings, which it reported last night after the bell. The assumption is that the coast is clear, the next Tesla is back on track, and this thing is just going to run. But here is the immediate insight, the reality that makes this morning's 9% pop so fascinating. The stock actually fell in after-hours trading yesterday. Right after the numbers came out, the stock dropped over 5%. So what happened between 5 p.m. yesterday and 9:30 a.m. today? The market had to digest a report that was one of the most complex and confusing that Rivian has ever posted. This isn't a simple they beat or they miss story. The general belief is that Rivian is just a truck company, and we just need to count how many R1Ts and R1Ss they ship. The reality, revealed in last night's Q3 filing, is that Rivian might be changing into something else entirely, and the market is scrambling to figure out what that means. Let's break down that report, because that is the only thing driving the stock today. The headline numbers were, on the surface, very good. The company reported a loss of 65 cents per share. That sounds bad, but Wall Street was expecting a loss of 74 cents, so that's a significant beat. Revenue also beat, coming in at $1.6 billion when the forecast was for $1.52 billion. They delivered 13,201 vehicles, a new record, and crucially, they posted a consolidated gross profit of $24 million. This was the first thing that grabbed headlines. Rivian is, on some level, gross profit positive. This is the expectation part of the story, the part that bulls are clinging to. They're logging into their Fidelity or Robinhood app and seeing the green, and they're thinking the long-awaited turn has finally happened. They're telling their friends that the online investment thesis is paying off. But the reality is buried one layer deeper, and it's what caused that 5% drop last night. While consolidated gross profit was $24 million, the automotive gross profit was still negative. It was a loss of $130 million. This means that on the core business of just building and selling their trucks, they are still losing money on every single vehicle that rolls off the line. So where did that positive $24 million consolidated number come from? It came from an entirely different and frankly shocking line item: software and services. That segment reported a revenue of $416 million, a 324% increase from the year before. This is the Volkswagen partnership money. This is software development, and this is a high-margin business that, frankly, nobody was modeling. So the market had a split personality. The truck part of the business is still broken and losing money, but a new high-margin software business just appeared and dragged the entire company to a consolidated gross profit. This morning, the market has clearly decided that this new software revenue is the real story, and it's repricing the entire company based on it. This changes the entire narrative for an investor. If you're doing self-investing and you bought Rivian, you thought you were buying a car company. You were comparing it to Tesla stock. But now, is it a car company, or is it a software company like NVIDIA that also happens to make truck bodies? This is the kind of complexity that automated systems like Schwab Intelligent Portfolios or a SoFi Robo-Advisor have trouble with. They are built on historical data, and Rivian just threw a massive curveball. This is where investment help from a real analyst becomes critical. You can't just look at the PE ratio because there are no earnings. You have to understand this deep operational shift. This recent movement is all about that reevaluation. The traders using the full interactive brokers platform or the Fidelity trading platform are looking at the cash flow statement. And the cash position is still the big bad wolf at the door. The company ended the quarter with $7.1 billion in cash. That's a strong number. But their adjusted EBITDA loss, which is a proxy for cash burn, was still $602 million for the quarter. They're still burning through a massive amount of capital. The clock is still ticking. The $7.1 billion is a lifeline, but it's not infinite. This is why the stock is so volatile. It's a binary bet. People aren't just buying Robinhood fractional shares, they are making a massive bet on survival. And that survival now depends on two things: getting the R2 mass market vehicle to production and growing that new mysterious software business. So what does Rivian actually do? For anyone new to this story, the company was founded on the idea of being the Patagonia of trucks. Their R1T pickup and R1S SUV are high-end luxury adventure vehicles. They are beautiful, powerful, and loved by their owners. The other half of the business was the commercial side, building 100,000 electric delivery vans for Amazon, their largest shareholder. The expectation was that these high-priced R1s would provide the profit to fund the development of the R2, their cheaper mass-market SUV that will compete with the Tesla Model Y. That was the plan. The reality, as we've seen, is that the R1s are not profitable. They are negative margin. They cost more to build than they sell for. This has been the bear thesis for 2 years, and it's been 100% correct. It's why the stock fell from over $170 at its IPO to a low of $9.50. The core business was fundamentally flawed. It wasn't a growth story, it was a cash incineration story. This is why online investing can be so difficult. The product looks great, the brand is strong, the reviews are 10 out of 10. But the investment itself was terrible because the unit economics didn't work. It's a trap many retail investors fall into, checking their SoFi investing or Robinhood stock trading account and wondering why their favorite company's stock keeps going down. This is a far cry from a stable, cash flow positive giant like Apple stock, which you can comfortably hold in Fidelity mutual funds or Fidelity ETFs. Rivian is a speculative bet. It's not something you put in your Fidelity wealth management portfolio and forget about it. It's something you have to watch every single day. This is true SoFi active investing. Now, let's look at the future, because that's what today's 9% pop is all about. The future outlook is a race. In one lane, you have the R2 platform. The company confirmed again last night that the R2 is on track for deliveries in the first half of 2026. This is the vehicle that must save the company. The preparation for its launch at the Normal, Illinois plant is nearly complete. The company is even hosting an Autonomy and AI Day on December 11th. This is a direct signal that they want the market to see themselves as a tech company, not just a metal bender. This is the bull case. The bulls believe the $7.1 billion in cash is enough to get them to R2 production, and that new software revenue from Volkswagen will help plug the cash burn gap. They believe the R2, which will be a smaller, cheaper SUV, will finally allow them to achieve scale and positive margins. The bear case, the reality check, is that 2026 is still a long way away. That $602 million quarterly EBITDA loss is terrifying. They have to survive all of 2025. This means that demand for the current unprofitable R1s cannot collapse. But the IRA tax credits that were pulling demand forward are now gone. So bears are worried that R1 demand will fall, the automotive gross loss will get worse, and the cash burn will accelerate, forcing the company to raise more capital at these low prices, which would dilute existing shareholders. They look at the competition, see Tesla stock cutting prices, and wonder how Rivian can possibly compete. If you're a bear, you're not interested in their Robinhood crypto offerings, you're looking at the core auto business and you're deeply skeptical. This is the ultimate tension. The expectation is that this earnings beat, this $24 million consolidated gross profit, is the turn. The reality is that it's a pivot. It's a sign that the old business is still struggling, but a new one might be getting born. If you're managing your own individual brokerage account, whether it's a Fidelity brokerage account or an Interactive Brokers account, you have to make a choice. Are you betting on the R2 in 2026? Or are you betting on this new software business? It's not as simple as just buying an EV stock. You have to really understand the details. This is what separates successful investing sites from simple trading. I'm curious what everyone watching